Here, the elementary trading algorithms obtained by comparing the price with the value of the overlay are described. In this case, the overlay is the base indicator. The algorithms comparing the price with an overlay are price much greater than overlay, price greater than overlay, price much less than overlay, price less than overlay, price almost equal to overlay. More precisely, the price is not compared with the overlays itself, but with its moving average for greater flexibility. For each of these, you can choose what price to use: close, high, HL average, which is the average between high and low, low, OHLC average, which is the average between open, high, low and close, typical price, which is the average between high, low and close. So we have all possible combinations for each overlay. The price much greater than overlay algorithm checks whether the price is greater than the moving average of the overlay plus a threshold, that is a particular value input by the user. So the algorithm is true if and only if the price is greater than the moving average of the overlay plus threshold. For greater flexibility, the threshold can be negative too. In that case, the algorithm is true even whether the price is slightly below the overlay. The name of the algorithm would then be kind of a misnomer. The price greater than overlay algorithm checks whether the price is greater than the moving average of the overlay. So the algorithm is true if and only if the price is greater than the moving average of the overlay. The price much less than overlay algorithm checks whether the price is less than the moving average of the overlay minus a threshold, that is a particular value input by the user. So the algorithm is true if and only if the price is less than the moving average of the overlay minus threshold. For greater flexibility, the threshold can be negative too. In that case, the algorithm is true even whether the price is slightly above the overlay. The name of the algorithm would then be kind of a misnomer. The price less than overlay algorithm checks whether the price is less than the moving average of the overlay. So the algorithm is true if and only if the price is less than the moving average of the overlay. The price almost equal to overlay algorithm checks whether the price is around the moving average of the overlay within two thresholds, that is, two particular values input by the user. So the algorithm is true if and only if the price is greater than the moving average of the overlay minus threshold, and simultaneously less than the moving average of the overlay plus threshold. For greater flexibility, thresholds can be negative too. In that case, you can check if the price is within a set range, not necessarily around the overlay line. A classic way of trading a price average is to go long when the price breaks over it. We can use the linear weighted moving average as a moving average, although usually an SMA or EMA is used. Traditionally, the price refers to the close price, so we can use the close greater than MA of linear weighted moving average algorithm. When the algorithm is true, the close is above the average and you can go long. So put this algorithm in the long tab. If you combine the previous trading algorithm with others, you might find appropriate to enter a long position not whenever the price is above its moving average, but only when there is the breakout, that is, when the price transitions from below to above its average. For this, you can select the Step checkbox, detecting the transition from false to true of the algorithm. Now the algorithm is true only at the exact instant of the upside breakout. Another classic way to trade overlays, represented as bands or channels, is through the breakout of their lines, very similar to the previous examples. For instance, it is suggested to go long when the price breaks over the upper line of the channel. If you want to give this algorithm a try, you can select a channel overlay, like the Duncan channel, also known as price channel. You might want to consider a breakout even with a high price, not necessarily with the close. In order to avoid whipsaws, you also may want to have a bit of margin before triggering the signal. So select the high much greater than MA of Duncan channel upper line and trim the threshold input parameter with a positive value appropriately, as this is your margin for whipsaws. When the algorithm is true, the high is a little bit above the upper line and you can go long. Here you can see we avoided a false signal causing a whipsaw just before the actual signal. Put this algorithm in the long tab. In the previous example, we went on a conservative path, delaying the signal to avoid false signals. If on the contrary you want to act more aggressively and try anticipating price moves, you can apply the same algorithm as before, but this time opting for a negative threshold. This way, the algorithm is true whenever the high price is above the upper line minus a margin. Here you can see that we anticipated the signal by a few bars. If the market is in a congestion phase, the price could oscillate within a channel overlay, its trading range. If this is the case, you can go short when the price approaches the upper line from below, because it is likely to bounce back downward. For instance, you can select the OHLC average much greater than MA of Duncan channel upper line, with a negative threshold. The threshold indicates how close you want the price to be to the upper line for entering a short trade. Put the algorithm in the short tab. The algorithm is true when the price is above the upper line minus a margin. In an uptrend market, the price could walk, as it said, the upper line of a band. That would be an indication of strength. However, if the price is too higher than the band, that could be a sign of overbought market and foreshadow a decline. By applying an algorithm like HL average almost equal to MA of a Bollinger Band upper line, with appropriate thresholds, you can spot where the price is close to the upper line. Not too higher, not too lower. When the algorithm is true, the price is close to the upper line and there is an uptrend. When the algorithm is false, it could be either an overbought, a downtrend or a congestion market. Here you can see we correctly spotted an overbought condition that led to a strong correction or downtrend. You can end this algorithm with others to be sure to go long only in an uptrending market or to liquidate in overbought situations.